What traders? Mark Bauman here, starttrading.com. I'm a serial entrepreneur that has a knack for trading, knack for business, and I like to share that with people. And that's why I started Start Trading, or acquired it rather, to share that experience with you. So I'm just now getting my streaming software up to date. If you haven't already liked or subscribed to our channel, please do so now. You just click the little like button down below or the subscribe button over here on this side. And thanks for joining. So first we're going to get over to the hearing on GameStop in just a minute. I don't see anything relevant that we want to jump into. So I'm going to cover right now the either crash or dip opportunity. So we were up at $206,000, 201 I guess according to TD Ameritrade, but so we're kind of fallen back to February 11th numbers, and we dropped down 17,000 yesterday to come back up from 201,000 down to 188,000, then back up to 196,000. So it's not a good kind of indicator that we keep on dropping further and further, but we dropped 8% this morning, another 17,000. And so I wanted to show you some of the moves that we made in order to prevent further losses. So some of our our trailing stops kicked in. So you can see that our stop market kicked in for Upwork for February 19th because that dropped down to 1810. Ooh. And then I did not think I was going to hit that. But instead of having that loss, we bought to open at 55 cents more for tomorrow, which I'm going to sell by the end of today. At least two of them, and I might hold one for tomorrow because I'm hoping for a rebound. Then we also bought to open Upwork expiring June 18th. So we saw an opportunity because it was so low for a June 18th purchase expiring again in June 18th. So that's also a possibility. In addition to that, we bought some VGAC because I saw that was on a dip, a good dip, and I still think that has an opportunity to skyrocket once that merger is announced. So I did a little bit of future casting there, and cost average down because we have some losses there. And I think at the time we bought it, I would not don't go and buy these right now because again the dip happened this morning, and I'll show you what I mean. Let's go to CCIV because we bought more CCIV. And let's look at the 1 day here. Let's go ahead and bring out the chart separated. Now CCIV is a great example because this one has the same pattern as yesterday. It was down this morning, and now it's back up already. Let's see the last hour. It looks steady. Hopefully it'll pop back up by the end of the day. But this morning is down at 57. Then it popped up. This is where it started. It started with a little bit of a dip and then popped all the way up to 61.8. Then it dropped down and then down further. So we got in somewhere around here. Let's see where we got in. Hopefully we got in somewhere around there. And hopefully we rode that back up a little bit to get back some of those profits. Yeah, we got down to 57. So it's already back up to 59. So that's already a 5% return. So we bought, 57 got rejected. Oh, good. We got 80 at 56. And we bought 100 at 59. Well, it's okay. So we had planned to buy at 59. I think that's why that kicked in. Now, some of our trailing stop losses. Oh, AIEQ. I like this one. And this one, I set 2 trailing stop losses. That's why there's 2 sold, because I had a certain percentage, and then I think it was like 6%, and if that hit drops, but if it drops 10%, just sell all of it. So it looks like we're completely out of AIEQ. I guess artificial intelligence didn't really account for that, because we set a pretty high trailing stop loss, I believe, on that. Then OGI, also that sold out this morning. I think we just went too far down as far as acceptable losses. So OGI is probably, I think, going to dip again tomorrow, and then maybe we'll get back in then. AIEQ, maybe the same as well. On STMP, I had some good hopes for this. I saw that was on the upward tick, and then, of course, the drop today hit it pretty hard. So we got in, again, to CCIV. We got some more Upwork, and we got some more ZOM as well. ZOM, I'm buying a little bit in. I'm going to buy, if it dips again tomorrow, down to like 190, I'm going to buy like 500 shares or more. Looks like our SNDL got rejected, so I'm going to have to check on that. I thought we got that. And then VGAC, because I saw that as like a major dip with a, that's kind of like a long shot out of all these. ZOM, I think, will be solid. VGAC is maybe in a week or two will be solid. Maybe this week, you never know. And then CCIV for sure to buy tomorrow will be solid, and next week. And then Upwork is very solid. So let's go to the positions, because if you see the screenshot we posted on social media, I think we were down to 180 and we're already back at 182. And I believe just like yesterday, we'll use CCIV as an example. Just like yesterday, you'll see a run up on the 2-day. You can see what happened. So CCIV yesterday dipped down here into the red, popped back up, dipped down again, and then had a run. So hopefully around the same time, which is in about 2 hours, we will see this happen. I think we're already seeing it. You can see, look, it's setting new lows, new bottoms, and new highs as the day goes on. Oh, this is not looking encouraging, but setting new lows. So could be that it's only going to go back to where it was, but we'll see. You never know with CCIV, because they could just make the announcement finally. And anyways, I want to share that with you. I also wanted to share with you our eToro count, which you would have seen. That's some tech I'm working on, analyzing sentiment string. Well, while this is loading, the tech you just saw on Google is something I'm working on. I own a technology company where we spider the internet for keywords for content creators, and we remove stolen content as a service. So I'm going to use that same technology, and I'm going to track the mentions of certain stocks and then do a sentiment string to attach that to the changes in the market and in the stock's trading volume as well as price. And I will provide the software to our start trading viewers and listeners. So if you're into technology, which like I am, you should definitely stick around and be sure to subscribe to our channel, because we're going to be sharing a little bit of that technology with you as soon as that is done. Now, as you can see here, we're at $8,113. I don't know what happened there when I moved the screen, but it's not loading. Well, I'm going to move this over so you can see it. Let me break this out on the software here. What's going on? It's lost the background. Oh, there we go. Okay. So as you can see, we are up $8,124 so far. Again, we just caveat last week we put in $15,000 extra dollars because we saw the market was going to bounce. It did. So we were 20% profitable, and now we are, after adding those funds, we're still 20%. We're actually 23% profitable, somewhere around there. All right, so now let's go on over. So now that we've covered tips to time the market during the trades, we're going to hop on over to the live broadcast from the Senate. I think it's the Senate. It's having a hearing on GameStop. Let's jump over there. Oops. That. There we are. And let's see if there's anything interesting happening there. It's Carolyn B. Maloney from New York, 12th District.
Looking forward, what operational changes is Robinhood making to better respond to future market volatility, to improve transparency with your customers, and to ensure retail?
So if you weren't watching earlier, so the Robinhood CEO came on and he gave a sob story about he's a kid trader and et cetera, et cetera. Then the other hedge funds came on and told their story about how there used to be kid traders, et cetera, et cetera. You should feel bad for us because we were one of you. They were trying to be relatable. And then, oh, here he's speaking now.
Future market volatility and other similar black swan events. And I believe that even throughout this process, we improved our risk management processes and strengthened them so that the experience customers had on Friday of that week was much improved from Thursday. And we'll continue to learn and improve upon this.
Ms. Wagner?
Okay, so they're going to lay into them because from my perspective as a trader, and your perspective probably as a trader, they stole your money. They are Robin the Hood, as they've been referred to. So they are the Hood Robin, not the Robin Hood. And they basically stole your money. They stole my money and many others in order for them to not lose money. So what was going to happen was if those the companies that were shorting the stocks, the capital groups, would have hit that second short, they said it would have collapsed the market because those capital groups would have had all these calls on their shorts, which they would have had to pay up or bought shares to cover, which they definitely had the money on. Let's all face it. Okay, they had the money to cover those if they had to. And they said they would have defaulted, which then would have caused Robinhood to default on their obligations, which then would have been crashed Robinhood and the funds. So for us, who cares? That's their problem. They stole your money and my money so that they wouldn't lose their money. So it's hopefully the representatives here that are running this hearing are going to pick up on that and really come after them on that, but not just in a dramatic way for show, whatever, just for the hearing, but hopefully they put up legislation today. But we'll see. There's a lot of naysayers saying there's not going to be any new legislation. Robinhood's going to get a slap on the wrist. But it's up to you, me, and others to join a class action lawsuit against them to recover our losses and our potential gains that they stole from us.
Let me sadly say, and allowing Main Street Americans access to the financial instruments that can create long-term investment savings. All of these changes have given millions of Americans the ability to invest better for their families and their future. My hope is that the majority does not use this hearing as an excuse to once again add new federal regulatory burdens to an industry that is already heavily regulated, that will prevent people from participating in our capital markets. Letting existing regulations work is key, not burdening everyday investors with new and more costly barriers to entry. Mr. Tanev, it appears at the time your company did not have enough money to meet the collateral requirements for that level of trading by your customers. In your view, A, were collateral requirements from the DTCC unreasonably high? Was the amount of trading on your platform unforeseeable? Or was your company undercapitalized given its risk profile?
See, these are good questions, and as soon as he responds, I'll cut back. But they had the money to cover it. I think this is a BS excuse, in my opinion. I think hopefully this representative and the others are seeing through their excuse.
There have only been tens of thousands of stock market deals in the history of the U.S. stock market. So a 1 in 3.5 million event basically is unmodelable. That said, we can learn from it, and in this particular case, our risk management processes work appropriately to keep us in compliance with all of our deposit requirements and collateral requirements.
Mr. Tanev, I realize that you are doing a full review of your practices and such. I encourage you to do that, and certainly communication with your investors is going to be key to that because you didn't communicate with them early on. On the Diversity and Inclusion Subcommittee, I am delighted to be speaking with our witness, Ms. Jennifer Schultz. Ranking Member McHenry and I have spent countless hours stressing the importance of having qualified women in finance. So I'm pleased to have you here today to lend your expertise. Ms. Schultz, we now know that it was the daily collateral demands set by the National Security Clearing Corporation that were the reason Robinhood had to temporarily restrict trading. Can you briefly explain the purpose of these capital requirements and their overall relationship to ensuring?
Now, in my opinion, these people are doing a two-step right now. Don't be fooled, everybody. So she just basically laid cover in her question for this lady that's coming up next. I don't know who she's with. Let me see. She's obviously with the short sellers and Miss Jennifer Schultz. I'm going to look her up, but I don't know who she's with, so I don't want to misspeak. But let's hear what she has to say. But she just laid cover in that question for the reason they stole our money.
The process to clear. During that time, the brokerage firm, the DTCC, the brokerage firm on the other side can remove the risk of that stock not actually clearing. And the collateral requirements are in place to mitigate the risk that the brokerage firm will not be able to make good on its promises to sell or buy. I didn't see any broad-scale failure. DTCC's collateral requirement was large, but understandable. And I think things function largely correctly.
My time has expired. I thank you all for your testimony, and I yield back, Madam Chairman.
Thank you, Madam Chairman. Madam Chairman,
She just knocked down that excuse of a poor excuse of a question that they tried to lay the groundwork for a excuse for why they shut down the trading. So that'll be interesting to hear what these next representatives have to say.
Okay. Just remind everybody, mute when you're not speaking, that's all.
thank you very much. And you heard Mr. Perlmutter. I would hope that every member would.
It's like a room full of boomers live streaming. Not that my live stream's any better. I just figured out how to use this streaming software, but this is pretty entertaining, at least to say the least. Our congressional and Senate boomers.
It's not free. Your product, someone else is the customer. You go on to Facebook and it's free. You're the product being sold to the advertiser, and your information is sold to God knows whom. So we now have a system where we're telling investors that it's free to invest to buy and sell stock. There are two ways to pay the folks involved in Wall Street for buying and selling stock. One is a commission, and so you discourage in stock because they have to pay a commission, and they know they're paying a commission. The other way to do it is to give them a worse execution. Or whenever there's a stock being purchased and sold, the market maker, perhaps Citadel, might be willing to sell the stock for $10.05, but will buy it for only $10. The difference is 5 cents. And so the issue is whether Robinhood and other people who are being told you get it for free are really getting it for free. Mr. Griffin, you're a market maker. You pay some brokers for order flow. You don't pay others for order flow. So when you pay for order flow, you're not making as much on the transaction. You have to pay some of that back to the broker. That's hidden from the amount of that is hidden from the customer. The fact that it exists has perhaps recently been disclosed. SEC rules require that people get the best execution, but I've recently learned that there's best execution and enhanced pricing. So if you get an order from Fidelity, you get an order from Robinhood, and you're paying for the Robinhood order flow, is the Robinhood customer getting as good a price as the Fidelity customer? Mr. Griffin.
Sir Congressman, I believe it's an excellent
He's going to two-step this. Watch this one.
policy that we can provide as measured in terms of price improvement is heavily related or correlated to the size of the order that we receive.
So he's basically two-stepping. So basically he's saying the bigger the order, the more money they make. Because you buy something at $50, they actually buy it for you at $50, or at $49.50. They keep that 50-cent spread. And you still hold the stock, and it looks like $50 in your account, but it's really $49.50. Then when they sell it, they also take another 50 cents, or whatever they want on the spread, to be honest. So Robinhood actually, each transaction, because standard broker accounts like TD Ameritrade, they take like 50 cents to $1 per transaction. Like I think I bought $15,000 call option with Shopify, and I looked at it, it was like $3 or $6 they took on the trade. It's like nothing. Robinhood could be taking 50 cents per share on the trade, or 1 cent per share on the trade. And because they were keeping this spread, their whole business model is flawed and may have been a contributing factor as to why they couldn't keep capital, the right amount of capital on hand. And so that's what this congressman is getting at.
Panel of the order. This is a commonly understood phenomenon in economics that channels matter. So, for example, when you go get a mortgage from JP Morgan, their clientele has a different rate of interest.
Okay, reclaiming my time, sir. Who gets the better deal? Okay, one that comes from a broker who is paying the being paid for order flow and one not. It's that on balance, there is no difference, assuming the same size of the order.
So, as I said earlier, size of the order is only one factor.
You are doing a great job of wasting my time. If you're going to filibuster, you should run for the Senate. Everyone else I've talked to in this industry says when you pay for order flow, you get when your broker is being paid for order flow, you get a worse execution. Otherwise, you're in
Liquidity, stability, additional avenues for households to build their wealth. And it's important.
Okay, so this guy's going to babble on, and he's going to do his thing. Each of the congressional members come in and they have their spiel, the predetermined spiel they want to do, either for dramatic effect or for their own personal gain. So that's you can skip past that. But we're going to keep on watching. It's important what was just disclosed in that last question, and hopefully another congressman or woman follows up with the same question. In that, are you making more money? Is Robinhood making more money than, say, TD Ameritrade per trade, which I believe they are, because of that spread that they built in there? But they tell you it's basically they're lying to you. They tell you it's free trading, but they're just kicking in their percentage in your trade. So it's not free trading. They're just making they've built a system that basically makes an educated guess that, not really educated guess, but more, a certainty that they create this spread that they make sure they make a margin in when they make that purchase for you. So they're making the purchase for you, but they're saying, okay, we're going to make this purchase for you, but we're going to add a tenth of a percent on top. Which, if you buy a $50,000 trade, which the average order is $50,000. You're actually Vlad speaking. 1 second.
System routes orders based on who provides the best execution quality for our customers. So the reason Citadel gets a relatively high percentage of our customer order flow is because they provide superior execution quality for our customers. And that's first and foremost the most important consideration that we look for. How are our customers getting the best execution quality? If another market maker were to improve upon the execution quality that Citadel Execution Services provides on any subset of orders, our system is set up to automatically route more traffic to that market maker.
So interesting. So he asked them, why do they choose Citadel over another?
And having lived through Dodd-Frank before, I see where sometimes major things can occur. I want to turn to Mr. Griffin. Could you also elaborate on how payment for order flow provides makers respective? Could you expand on that? As you outlined in
So, as the CEO of Robinhood just set forth clearly, the orders that are allocated amongst the market makers today are allocated principally on the basis of pricing. We have fought for 15 years to make that the basis by how which orders. I believe that Citadel is able to provide a better execution for retail orders. In the long run, we make a huge investment in our team and our technology to do so. Because exchanges are limited in their ability to do business by regulatory law, a minimum 1 cent wide market, which for low price securities means that they are less competitive than they otherwise could be. We're able.
Are you here and what are you doing?
Excuse me.
That wasn't either one of us. Continue, Mr.
So we're able to share our trading acumen with retail investors.
Not sure what that was.
We're able to give them a better price, and we're able to make payments for order flow to firms like Robinhood that allow them to have lower, or today in most cases, no commission. And of particular note, we're able to help Robinhood and other brokers pay exchange fees. This has been very important for the democratization of finance. It has allowed the American retail investor to have the lowest execution costs they've ever had in the history of the U.S. financial market.
In the Dodd-Frank process that the chairman and I went through a decade ago plus, there was much discussion about margin requirements. Give us just a discussion, for instance, about when you discovered you had a $3 billion additional.
I believe the full play-by-play of that situation was described in detail in my written testimony. Just to clarify,
Boomer's got to mute.
this decision had
My
nothing to
time
do
is
with margin.
expired, unfortunately. Thank you, Madam Chair. I yield back.
Has expired. Mr. Meeks, you're recognized for 5 minutes.
Thank you, Madam Chair, for member. Let me ask a question to Mr. Tamid. I've been burnt once or twice in the market, and but particularly since I've been a member of Congress, one of the things that I recall greatly was the financial crises in 2008. And it is, we thought that opening the market up, that people who had adjustable rate mortgages, et cetera, that were able to get into the market, people who may not have been before, that the people would not be able to afford them and they would default shortly thereafter. Now, so I understand your model of trying to get more people, more democratization, but that means that there's a responsibility of ensuring that your customers have all the information they need to assess risk. For me, the information that has to be digestible and accessible. Now, one of the problems I have, for example, you're allowing up to $1,000 to buy stocks on margin and buy. So, how do you disclose this? How do you make the determination of individuals who are and allowing them to buy these risks on margin?
Thank you, Congressman, for the opportunity to address that by saying that about 2% of our customers, 13% on a monthly basis, perform an options transaction, 3% perform a multi-leg options transaction. So the vast majority of our customers are engaging in buy and hold activities and long-term investing on our platform. $1,000 margin, that's actually something that we refer to as Robinhood Instant, and it's provided as a courtesy. When a customer initiates a deposit, we allow them access to up to $1,000 of that